All right, welcome everybody to our Expert Club sesh. We have a great guest today, Brad. I'm going to mess up your last name, Brad Kadelski. Say it right?
You got it. It's just how it looks.
and Brad is an interesting guy I met a few weeks ago in a space that I think a lot of us probably don't pay enough attention to. I was raised in the investment world as part of a broker dealer that was owned by an insurance company. So insurance has always been kind of this weird element that I didn't have a lot of expertise in, but I was always around it. One thing I have found out over the years is I've had quite a few clients reach out to me about key man and non-qualified deferred comp. So other type of plans and components to executive compensation outside of the 401k world. I did have an insurance license for a while. I let it lapse. I don't have time to focus on insurance, but I had it for a while and I did do a few key man policies, just term policies owned by the business that covered the executive team. So I really felt like this topic was something we should touch on and talk about. And when I found Brad and the relationships he has his own firm called Brookfield Insurance Partners, but he's also tied in with a couple of other different channels, including Alliant Insurance Services, which if you know Aaron Potagen out of Austin, who's a pretty loud 401k voice on LinkedIn, he also works at Alliant. So when I made the connection there and I talked to Brad, I was just really impressed. And I thought, you know what, Brad needs to come talk to the club and just give us some sort of a sense of what opportunities to look out for, so we don't really give away something that could at least be a good connection for you to make for your clients. So with that, I'll let Brad, if you want to give us a quick 2-minute background, how you
Yeah, sure.
Here, and then go into just teaching us.
Yeah, so to give a little bit of my background, this year marks the 20th year in my business dealing with insurance. And I focus on predominantly the executive benefits space at non-qualified benefits. Non-qualified benefits can be a bunch of different types of plans, whether it's split dollar life insurance, true non-qualified deferred compensation, key person protection. And one of the things that Jake and I started talking about, and one of the most popular topics that we talk about is with business owners, is how to retain that key employee to that business. Now, a lot of people think, well, I'm not really concerned about life insurance with that key employee because what's the probability or what's that statistic of them having a premature passing? While it can happen, it is very few. I think really what a larger hot button is to many employers is, well, how do I keep that key employee from going anywhere? How can I golden handcuff and retain that key employee? And that's kind of what we focus on in the type of plans that we put together. Most often those plans are using a life insurance policy as a funding mechanism. And really that's because it's got some interesting characteristics to it. You can grow money on a tax deferred basis. You can take out money on a non-taxable basis using policy loans. And it's really kind of the only product you can do that with. Many people think, well, what if we were to do an annuity or something like that? Well, you could use an annuity, but corporations don't have that same tax treatment with annuities that they do with life insurance. Could you use investment funds and just straight up investments? Yes, you could, but one of the downsides to that is all this money typically is going to be on the employer's books, and any of that growth is going to continue to be taxed. So this way, by using an insurance product, they're able to put that money in on a tax deferred basis. But then also, if something were to happen and they were to prematurely pass, the company's got a way to return some of the money that they've put into this type of thing. So it kind of has a dual purpose of both key person protection, but also providing that pot of money later down the road to tell that key employee, like, hey, we're going to put maybe $10,000 a year for the next 5 years. And I know Jake's seen some of these plans, that some of his competitors have talked about. And maybe 15 years down the road, if you do this, this, and this, you'll then be entitled to this chunk of money. Now, 401ks are go ahead.
Real quick, Brad, I want to just add in. So this is a case, like the case that just hit my desk. Literally, it's a great client, and the CEO, well, the owner is trying to incentivize the CEO to stick around. So they want to put the bonus in some sort of a golden handcuff, non-qualified plan. Well, he reached out to one of his buddies that does, insurance mainly. And then they put a pitch together. And then they also said, yeah, and we can have one of our competitors, one of the 401k competitors we have, manage the money for you. So I automatically, I had to jump right on this because this is a big threat to the client relationship, because I don't want a competitor managing this money, because that's another way they can kind of weasel away into the 401k. I want to protect that. So even if you don't want to be the one to put these plans in place yourself, and you're not insurance licensed or don't have anyone on your team, you need to find partners to work with. And that's the key here, because you're going to, if you haven't had this happen, it's going to happen. Someone's going to bring up key man or this non-qualified idea. So sorry, go ahead, Brad. I just want to tell everyone I have this.
Yeah. And I mean, many of those people, they might have an executive benefits space. For instance, I know Hub, for instance, they have their own 401k division, and then they have an executive benefits division, and they're kind of working hand in hand. So if you don't have that other partner to kind of handle this, it might kind of put you at a disadvantage in certain instances, in certain cases. And that's where I can help you and kind of partner with you to help you with your practice of talking about non-qualified benefits. Many times people think, well, if we have a good, and not to knock a 401k, but if we have a good 401k program, it might retain that key employee. If we have certain profit sharing components to it, we might be able to return that key employee. But by adding just another hook into that employee through some sort of non-qualified benefit plan, we can really make sure that that employee's not going to want to leave us to another competitor. And, that's really kind of your largest risk with those key employees. Yes. Could they have a premature passing? Absolutely. Could they have a premature illness, or have an illness at some point in their working career? Absolutely. But I mean, really, when you look at all the things that happen with key employees, they end up losing them to competitors, or it's another business owner, business partner that's might decide, you know what, I've had it, and I'm going to go start my own company and basically go directly into competition. Now, I was on an interesting call the other week where there's some legislation going on nationally right now where they're trying to basically end do not competes. Now, in the law space, do not competes rarely kind of exists, but in the corporate world, we see a lot of do not competes. And if this legislation goes through, you're going to see a lot of business owners saying, all right, if I can't have a non-compete, what am I going to do to make sure that those employees aren't going somewhere else?
So what's the starting point? I mean, I think having this conversation with your client, and this is a part that I've always focused on, is like, you got to go into their world, know what their problems are. And so hopefully this is a conversation you can have with them to say, what are you doing to keep and retain the key people and keep them safe? Because a non-qualified plan versus a key man, kind of two different goals, right? Like they're not
correct
necessarily. I mean, so maybe to start there, give us some, what questions should we ask? How do we get that conversation started with the client, first of all?
Yeah, I'd say the number one question to ask is, do you have any programs in place to keep some of your key employees from going to another competitor? And just pause right there and let them talk. And they'll be, what do you mean? What do you mean? Do I have a program in place? Well, let me ask you, what would happen if one of your key people were to leave to a competitor? Would that have an impact on your business? Would it make sense for you to set aside, a percentage of their pay, each and every year, and maybe dangle it out as a carrot 10 years into the future? Would that make sense? And if they don't stay that 10 years or they don't meet certain requirements, you get to take that money back. You don't have to give it to that key employee.
Right. So it's kind of, I mean, just like we do with vesting schedules, it's kind of a similar concept where
correct,
we're investing in this person, but both of us have skin in the game. Like they have to stick around. We're going to follow through. If they don't, we get it back.
Right.
What about the structure? So let's talk about that for a second. So my understanding is very similar, and I've only put a few non-qualified plans in place, and I've done it I would say probably the simplest format I could. I didn't involve an insurance company, so I want to talk about the differences there. But I involved a third-party administrator to set up a 409A, right? So that's the maybe you want to explain some of that if you want to. But that's what I've dealt with. And when we set up the plan document, there's a lot of customization to that. And then we have the separate brokerage account where the company puts the funding and we invest it for them.
Right.
That's one way of doing it, but tell me more.
Yeah. So some of the things to be concerned about with 409A plans and doing 409A is just, again, tax deferral is going to be a big thing. So you're not going to be able to tax defer that growth. But there might be some ERISA requirements that you're going to fall into where you have to do this with so many of those key employees, or you got to pick and choose so many different employees. Whereas these non-qualified benefit plans using life insurance products, they're going into a piece of the tax code where we aren't governed by ERISA. So we can pick and choose certain, we can pick one or two key employees.
Right. So it doesn't have to be offered to everybody. That's a real big factor when you're trying to talk, well, there's cash balance option or ESOP option. Like you have to really deal with ERISA in those type of accounts, but or plans, but this doesn't have those same rules. And then you're also hitting on the point of insurance has the tax deferral component, right? Which is just the growth of the basis, really, the money that goes into the plan.
Right.
Would that be
and yeah, and actually, and also in regards to some of these insurance products, these aren't typically your off the shelf insurance products. These are more institutionally priced products, depending on the amount of lives. Where there's, one of the downfalls that you'll get if you're doing one or two policies is that you're going to have to go through medical underwriting, and medical underwriting these days can be very difficult. Many of the carriers have simplified issue requirements. If you're only doing it with a few people, they might be able to not have to have, they might not be required to do an exam. And, I'd say if we're over 10 employees, many of the carriers that we work with will have a program where we can do it on a guaranteed issue basis. So there's no medical underwriting. It's what we refer to as a census-based enrollment. So we're sending that census over to the carrier. They're issuing up to a certain amount with no underwriting.
Okay. And that would be on the non-qualified deferred comp plan. The insurance component in there would still have underwriting.
No, we could even do it with a split dollar, if we have the numerous lives and we can group together those numerous lives, we can do something on a guaranteed issue program.
Okay. And are all non-qualified deferred comps, are they funded as you go, or is it something that can be a liability that builds up and then they can fund it later?
Yeah, I have not seen that. I mean, I suppose you could do that as an unfunded, and then, or I mean, actually, I know you can. I know you can do it, and I know you can do it, and it would be a liability down the road, and it would be a liability that you got to post on your balance sheet, and then when you get 10 years out, you could pay that out of current cash flows. That's definitely an option. But again, now you're posting something as a liability on your balance sheet with nothing to match to it.
Right. Right. So yeah, I mean, that's where the employee would be like, I want this funded as it goes, because there's not the same ERISA rules protecting them in a non-qualified plan, right? So
right. We don't know what cash flows are going to be 10 years from now. And if we can't pay it, now we got a problem on our hands.
Right. Exactly. So starting point. So you start having a conversation with your client and they say, yeah, we haven't done anything. We probably should. Then what? What should we do from there?
My best advice would be, to get someone like me on the line, or get me on the line, and, we have a call and do a little bit, further digging, trying to figure out, well, how much do you want to set aside for those key employees? What makes sense to you? What, because now it's coming down to their own personal cash flows for the business. Do we take 5% of their salary? Typically, we'll see between 5 and 10% getting earmarked each year for a certain period of time. Above and beyond what they're already paying that key employee. Could they take money back from that key employee? Yes. But usually this is something above and beyond. But sometimes we've had conversations where we're actually kind of split funding two different things. So we're doing one thing where the business owner is going to set aside this, all right, I'm going to set aside $10,000 a year for the next 10 years, and we're going to have this bucket of money for you. But let me ask you, and this is where you're doing like a kind of a one-way deal. And I'm actually working on this with a buddy of mine who's, he's doing pretty well in his own company, and, he doesn't need all of his money. So he wants to defer a piece of his money. So now we're, instead of that employer just putting aside 10,000, now that employee's also agreed to put 10,000 aside each and every year of his own income, and defer his own income, so he's not being taxed on it.
But it comes still company money, even though it'd be their compensation, right? It's not like a 401k deferral.
Yeah, this will be company money. It's not going to be a 401k deferral.
They're just saying reduce my
And
W-2 pay and put this amount into the
right,
non-qualified plan because I don't want to be taxed on it right now.
exactly.
Okay.
Yep. Yeah. Um, and
And then
yeah, I mean,
then
kind of
we put it into insurance product. So you do is this first step. Once they say yes, I want to look at it. Then we do an illustration to kind of figure out who would be the key employee that would need to be a part of this
right.
from the owner's standpoint. And every business can be different. Do you see trends on like different industries that this is more common? Like would it?
Yeah, I mean, smaller. I mean, there's two different markets. There's people that are playing in the large market, large, I'd say over 1,000 employees. I tend to not work so much in that space. We're typically working, I'd say, up to a couple hundred employees. The smaller the business, I think the more critical this type of coverage is, non-qualified, because you might have a 50-person company, but there's really probably 3 or 4 key rainmakers where this is, if one of those people were to leave, it would have a dramatic impact on a company. You take a company, you take a large company with 5,000 employees, you might have a few big key people in there, but they've already kind of got that plan to what's going to happen if they were to go away. What's going to happen, I think, more in those larger employer market cases is more of just your true non-qualified deferred compensation, where you have many key employees that are looking to set aside a portion of their salary each year.
Right. And the key benefit there is it's not income in that year. It's not the
Right.
growth will be taxed when you pull it, when you get paid.
Yeah, and one of the downsides that you'll get from the employer is that they're not going to also get that deduction each year. So they're setting aside some of the employee's salary, but they're keeping it in their own pockets, depending on their tax status, whether they're a S corp or a C corp, they might be paying corporate income tax. But that money's going to grow tax deferred. And then when they pay it out, it's going to, they get that deduction at that point as compensation later down the road.
Got it. Okay. So what would be the main benefit if someone's bouncing around between the idea of a brokerage account versus an insurance product inside of a non-qualified plan? What would you see? Is it just the deferred comp or the deferred tax growth? Or the deferred tax on that growth on the insurance product? Or is there other things that we should consider between the two?
It's the combination of the deferred tax and then also wrapping in that layer of key person insurance protection to protect that business owner. Because typically what you'll see in these plans is that obligation is there to that employee, even if they were to pass away in the meantime. So what I mean by that is, all right, we're going to set aside 10,000 a year for the next 10 years. And we're going to have this pocket of money for you, 100 grand, 10 years down the road for you. But what happens, now they have this obligation to pay a future amount to that key employee and to their family. So what happens if 2 years into this, he were to pass away prematurely? Well, by wrapping it into that life insurance, now the business owner is going to get paid back his money that he's put into this. But now he's also that promise to pay to that key employee's family. That's also getting paid out from that life insurance contract.
Okay. So they both benefit. Yeah.
Because if they've only put aside 2 years of pay and they have this future promise of 100,000, where are they going to come up with that money?
Right.
It's still that posted liability.
So is that the most common way you see it, where they're combined that way, where it's a non-qualified plan and a key man policy? Because the one I've done the key man separate, I've never done them together. Is that more common?
This is using the and what I'm referring to is more of like a split dollar life insurance plan, and those are the most common that you're going to see out there.
Okay. Yeah, interesting. Wow. So, okay. So what should we, if we do find someone that already has something in place, is it a good thing for us to say, well, let's review it and let's see if it's effective? I mean, if it's
let's look at how it's performing. I mean, many times people are using, what we see, and not to knock the product, but the products need to be managed just like you would manage an investment account. But if they're index universal life or variable universal life, they should be getting reviewed and looked at. Many times, unfortunately, you might, have a career insurance agent that put that plan in place and then never monitor it afterwards. Well, if you have some negative market years in there, especially, in the early years, that policy might be not, that policy might not achieve what they're looking to have it achieve. So reviewing that's definitely important.
Is that like an annual review, or how often are you saying look at it?
I would say, at the very least, I'd say every 2 years, to be honest.
Okay. And so
Um,
inside of those, I mean, who's all involved? Like, what's the team that is really involved? Because I've always done with a TPA, and then we just open a brokerage.
yep.
Tell
Yeah.
me
So
who the players are.
so the carriers we work with tend to have their own administration internally for these types of programs. So the big carriers that we're working with for this that have these types of plans are John Hancock, Lincoln, Principal, Securian. Um, they're the major players in this non-qualified space. And they have their own administration for these split dollar plans, where they're going to put all this out. Two carriers, or the two most well-known carriers I'd say for this, are Lincoln and Principal.
Yeah, I've seen Principal quite a bit. Interesting.
Yeah.
Okay, so all of these, yeah, all of these are definitely big players in the 401k space too, which is interesting because I don't think they really connect the dots between 401k and non.
Yeah, it's a struggle. I'd say Principal is one of the biggest carriers that's really trying to fix that and figure that out. They got this thing they call Principal One, where you have their life insurance division talking to their disability division, talking to their 401k, because if you're talking with business owners, all those things kind of take place together. So you would think these carrier representatives, for these different product lines would communicate more together.
Right. So do you think is most opportunities for these plans through like the PNC agent more, I would say more so than a 401k person? Or where do you get where do businesses turn to for this help, just like naturally?
Naturally, I'd say in that middle market type of company, they're naturally going to their employee benefits firm that they're working with that does their group health, because they think like, oh, well, they do the health insurance and the group disability, so that's probably the guy, to do something with insurance. They tend to have a misunderstanding. And I would say that a lot of those big firms, even though they do have an executive benefits division to them, some of them, they also don't work properly together. And, there's a lot of miscommunication that goes on.
Okay. Because those channels are some that I always talk about. Is you got your PNC agent, you got your health benefits, employee benefits broker, consultant, and then payroll. Like those kind of play in our same world, and where the 401k is a piece of all of those in some way. Well, more so the benefits and the payroll piece are need to be talking to each other. But this is another whole, I guess, niche into that benefit space that is really, I think, a valuable option for you to bring up, but you need to have the right people connected. Because if you're trying to be doing all of this and 401k, like you're going to struggle. Like I would never recommend that you should become, a non-qualified expert and then still try to be 401k expert, because it's a lot. I mean, would you agree, Brad?
Like, absolutely. I mean, do I know a little bit about 401ks from being in the industry for many years? Absolutely. But I mean, I couldn't begin to, not only just the issues of ERISA out there. I mean, I can't even figure out the investment side of it.
Yeah, there's it's a whole world by itself. It's enough for us. So the reason I thought it'd be really important to bring you in here is because we have clients and we're trying to do our best to help them. And a lot of times that help is outside of what we are experts in. And this is one area that I really think should be something that you bring up in your annual reviews. And it's not that hard. Like Brad said, just ask what they're doing to protect the key people. And you'd be surprised at how many haven't even thought it through. But can you imagine on the other side of this, if something did happen to that key person, they left, or something terrible happened to them, and you had put something in place for them? I mean, how locked in is that client for life because you really put them in a good place? And sometimes that's a good thing for being a fiduciary, as we are, to say this is a really important thing. And I don't have any like financial reason to bring it up other than I want to see you succeed and not have any big road bumps in the way, So what else would you add Because I want to.
Yeah, and I mean,
One
you're
question.
also protecting and insulating your own business by having that conversation to keep, that local, Guardian guy, Northwestern guy, New York Life guy from coming into that business owner and bringing up that same conversation. Because you very well know that even those career agencies, they're focused on looking for this type of stuff, but they also, nowadays do 401k planning. And if they can try to grab that, they're going to try to grab it.
Yeah, everybody's going to try to take a different angle and say, so that's why I think our angle should be experts in what we are doing, because someone that's just dabbling in 401k is going to run into problems. It's the same if you try to dabble in this, so partner with the right people is going to be
Hey,
critical.
Jake.
Yes.
Hey, quick question. Is it true that this really only works in an S corp or C corp, and anyone who's taxed as like a partnership that a non-qual really isn't a fit for, or is there workarounds depending on the entity type?
So I think what you're referring to is whether, being an S corp or a C corp for something for the business owner. When we're talking the business owner, that's a little bit different of a conversation. They're not going to get some of the same tax treatments, especially in these flow through S corp LLCs. What I'm typically been talking about here is with key employees that are non-business owners.
Okay, thank you.